Hello and welcome to my channel, The Quality Investor. Earnings season heat up this week, and after the bell today, Texas Instruments, ticker TXN, released their full year 2023 earnings. Texas Instruments. So disappointing. TI is one of the top players in the analog semiconductor segment, and I really view semiconductors as vitally important to our modern economy. Large and small, you're going to find semiconductors in virtually every electronic device that there is. However, it's also a very cyclical industry. And I'll tell you, throughout 2023, we've been trying to find the bottom of that cycle. So let's just get right into the earnings. But first, if you enjoy content like this, please hit that like button and subscribe to the channel. Also, hit that notification bell so you can know right away when I post more stock analysis content. So we are looking at their income statement for 2023, and let me just point out some of the lowlights right away. You can see their revenue, $17.59 billion, down 12.5% year over year. Gross margin also compressed. It compressed from 68.8% last year to 62.9% this year, nearly a 6% margin contraction. And I do not like seeing margin contraction. Operating margin as well. That contracted 10% from 51.9% last year to 41.9% this year. And then we have earnings per share, $7.07 earnings per share, down from $9.41 a share last year, or a 25.6% decline. I was looking forward to these earnings today. Aside from the fact that I hold Texas Instruments, I was curious what it might signal for the broader semiconductor industry. Well, these results scream weakness. Clearly, the demand has not picked up yet. On the earnings call, they said weakness in demand for the industrial and automotive markets drove these poor results, and they expect that to continue into Q1 of 2024. They also mentioned that customers are trying to rebalance their inventories, meaning they're trying to sell what they already have. So they're not actually buying anything new from Texas Instruments. This also caused the gross margin decline, indicating that the contraction was due to the factory underutilization because of that weak demand, and they had higher manufacturing costs. Here we're looking at a quick snapshot of their post-market decline here, and they closed the day at $174.34, although that's certainly going to fall tomorrow. You can see they've had a post-market decline of nearly 5%, at 4.5% here, and you can see right away after those earnings released that share price dropped like a rock. This post-market drop seems to be because of their guidance. They expect Q1 2024 revenue to be in the range of $3.45 billion to $3.75 billion. And if they come in at the midpoint, $3.6 billion, that's an 18% decline year over year. So the market is clearly skittish. Also interesting on the call, an analyst asked about the cyclicality and why we're heading into our sixth straight quarter of year-over-year decline. What is making this trough longer than other semiconductor cycles? Texas Instruments said that it is different this time because their end market customers all entered demand weakness at different times as opposed to past cycles. They saw weakness in personal electronics in Q2 last year, whereas automotive saw their decline in the past Q4. So all in all, TI was pretty adamant that we're in a weak demand environment. Customers are wringing excess inventory out of their systems, and that we should start seeing that churn back upwards by Q2 this year. In fact, Texas Instruments stated on the call they are starting to build their inventories with that expectation. Probably the best silver lining that was on the call. And you can see that here on their balance sheet. You can see the big jump from 2022 to 2023 of their inventories. 2.757 last year, now that nearly $4 billion in inventories this year. A large jump of that is due to the finished goods. So they are getting ready for what they expect higher demand later this year. But what does this actually mean for the valuation? I want to quickly point out some of the growth rate assumptions I'm using here. So I have revenue growing the next 10 years at about a 6% compound annual growth rate. Operating income at 7.8%, expanding to a 50% operating income margin in the next 10 years, an 8% growth rate for my net income, and then earnings per share at 8.3%, free cash flow growing at 24.36%. Now that might seem high, but remember, we're starting from a very low free cash flow amount here, something that's historically quite low for Texas Instruments. Another thing to note is they're actually investing quite a bit into CapEx, and that will be through about 2026, and that's at $5 billion per year. So you're not going to see real ramp up in the cash flows until about year 3 and 4 and beyond. So given these growth rate assumptions, and I do think they're fairly in line with what analysts are projecting as well, maybe a little bit under what analysts are projecting, what does their final valuation look like? So after updating for everything, I'm getting a discounted cash flow price here of $159.98. The dividend discount model gives us a price of $208.19, and Texas Instruments pays a very good dividend. It's $4.96. They've had 20 consecutive years of dividend raises. I don't expect that dividend to increase very quick in the next couple years due to that high CapEx investment, but we should see that grow after about 3 or 4 years a little bit faster. And for their peer comp, I have them at $204.44. Their peers averaged about a 23, 24 PE right now, whereas Texas Instruments, they're at a 22.7 PE. So what does that mean for our final valuation? Well, average those together, we get $183.15. Currently, they are trading at $174.34. However, let's be realistic. Tomorrow when the market opens, that will decline. That has a upside as of right now at 5%. And if we use a 20% margin of safety, that gives us an acceptable buy price of $146.52. And to me, that's pretty reasonable because we should not expect a lot of cash flow generation out of Texas Instruments in the next few years, and that does hurt their valuation. So with the very weak earnings that came out today, we should see that price come down to this range probably over the next couple of weeks. You can see their 52-week low of $140.50, which they pretty much hit in October after their last earnings release. So to me, Texas Instruments is a wait right now. That price will definitely come down. And if you're comfortable buying into it, once it gets below that 146, 145, pick up some shares. The price, it should be more desirable at that point. Overall, a very disappointing quarter for TI. I do believe that this is an issue of short-term demand, however, and not fundamental, so I don't think they are a business in decline. But before we go, I do want to emphasize that this is not financial advice, and I do own a sizable stake in Texas Instruments. With that, thank you for watching today's video. And what do you think? Let me know in the comments below. Also, please hit that like button. And if you found this info helpful, consider subscribing to the channel and joining our community. Thank you and happy investing.